A 2-1 adjustable rate mortgage, or ARM, is a hybrid mortgage loan that combines the stability of a fixed rate period with the flexibility of an adjustable rate. This means that the interest rate remains fixed for the first 2 years, offering borrowers predictable monthly payments during this initial period. After the initial 2-year fixed rate period, the interest rate adjusts annually based on market conditions. This hybrid structure can be particularly appealing to homebuyers who prioritize lower initial payments and anticipate either selling or refinancing their homes before the adjustable rate kicks in. Understanding the mechanics of a 2-1 ARM is crucial before committing to this mortgage option. For example, let's say you take out a 2-1 ARM with an initial interest rate of 4%. For the first 2 years, your monthly mortgage payment will be calculated based on this fixed rate. However, after the initial 2-year period, your rate will adjust annually based on a predetermined benchmark index, such as the LIBOR or the prime rate, plus a margin set by the lender. One of the most significant advantages of a 2-1 ARM is the lower initial interest rate compared to a traditional fixed-rate mortgage. This lower rate translates into smaller monthly payments during the initial 2-year period, making homeownership more accessible to a wider range of borrowers. For instance, a borrower might qualify for a larger loan amount with a 2-1 ARM due to the lower initial payments, enabling them to purchase a more expensive home than they could afford with a fixed-rate mortgage. This feature can be particularly attractive to home buyers in competitive housing markets where affordability is a major concern. However, it's crucial to remember that this initial period of lower payments is temporary. After the fixed rate period ends, monthly payments can fluctuate based on market interest rates, potentially increasing significantly. Therefore, borrowers considering a 2-1 ARM should carefully analyze their financial situation and long-term plans to determine if this mortgage aligns with their overall financial goals. While the adjustable nature of a 2-1 ARM introduces an element of uncertainty, lenders typically incorporate safeguards to protect borrowers from dramatic payment shocks. These safeguards come in the form of rate caps, which limit how much the interest rate can increase or decrease at each adjustment period. A common cap structure for a 2-1 ARM includes a periodic cap, limiting the rate change at each annual adjustment, and a lifetime cap, restricting the total increase over the life of the loan. For example, a 2-1 ARM might have a periodic cap of 2%, meaning the interest rate cannot increase by more than 2% from one year to the next, even if the underlying index rises significantly. Additionally, there might be a lifetime cap of 5%, limiting the total interest rate increase to 5% over the initial fixed rate. These caps provide some level of predictability and help mitigate the risk of drastic payment increases. Section 4. Potential risks, interest rate volatility. Despite the safeguards of rate caps, the most significant risk associated with a 2-1 ARM is the inherent uncertainty of future interest rate movements. If market interest rates rise significantly after the initial fixed rate period, borrowers could face substantial payment increases, potentially impacting their ability to comfortably afford their mortgage. For example, let's say you purchased a home with a 2-1 ARM at an initial rate of 4%. After the fixed rate period, if interest rates surge to 7%, your monthly payments could increase significantly, potentially straining your budget. This risk is particularly relevant in today's economic climate, where interest rates have been historically low but are expected to rise in the coming years. Therefore, borrowers considering a 2-1 ARM should carefully assess their risk tolerance and financial capacity to absorb potential payment increases. Section 5. Who should consider a 2-1 ARM? While the 2-1 ARM might not be suitable for every home buyer, it can be a strategic option for certain individuals or families. For instance, borrowers who are confident in their ability to refinance or sell their homes before the adjustable rate kicks in might find this mortgage structure advantageous. Additionally, those anticipating significant income growth in the coming years might be comfortable with the potential for future payment increases. Furthermore, home buyers seeking to maximize their purchasing power in the short term, knowing they plan to move or refinance within the initial fixed rate period, could benefit from the lower initial payments offered by a 2-1 ARM. However, it's crucial for potential borrowers to thoroughly analyze their financial situation, risk tolerance, and long-term plans before committing to a 2-1 ARM. Section 6. Conclusion: a calculated decision. Choosing the right mortgage is a significant financial decision that should not be taken lightly. The 2-1 ARM, with its hybrid structure of fixed and adjustable rates, can be an attractive option for some borrowers, offering lower initial payments and potential savings. However, it's essential to weigh these benefits against the risks associated with interest rate volatility and the possibility of future payment increases. By carefully considering their individual circumstances, financial goals, and risk tolerance, potential homebuyers can make an informed decision about whether a 2-1 ARM aligns with their overall financial well-being. A thorough understanding of the mechanics, benefits, and risks associated with this mortgage option will empower borrowers to navigate the complexities of the mortgage market and make a decision that best suits their needs.